Greetings everyone, my name is Mr. Chakacha. Welcome to my YouTube channel T.O.C Tutorials. In today's accounting lesson, we are going to revise a ZIMSEC ordinary level question paper, which is November 2024, paper 1. In this lesson, we are going to revise number 1 up to 10. Then in the next episode, in the next part, we are going to revise number 11 up to number 20. Number 1, it reads a sole trader. So this question simply wants us to identify what is correct about a sole trader. So before I identify what is correct about a sole trader, let's have a background information about a sole trader. What is a sole trader? So before I explain a sole trader, I want to give a definition of a sole trade, not a sole trader or a sole proprietorship. What is a sole proprietorship or a sole trade? A sole trade is a one-man owned business. What do we mean by that? It is a business which is owned by one person. The owner of that type of business enjoys all the profits. Since he is the only owner of the business, all the profits generated by the business, by his or her business, belongs to him, belongs to her. Then another characteristic of a sole trade, a sole proprietorship, the owner bears all the losses and risk alone. So the correct answer here is D. Moving on to number 2, it reads, which of the following are non-current assets only? Which of the following are non-current assets only? So now let's have a background information about assets and the nature of assets. What are assets? Assets are resources or properties of a business. In other words, we are saying assets are things which are owned by a business. Meaning to say, everything that belongs to a business, it's an asset. Moving on to types of assets. Types of assets. On types of assets, we are saying these assets, these things which belongs to a business, are divided into 2 groups. The first group of assets is called current assets. The second group is called non-current assets. So what is the difference between current assets and non-current assets? Current assets refers to assets which are supposed to be converted into actual cash in a space of 12 months. Taking for example, we have stock or inventory. Stock or inventory, it's a current asset. Then debtors or trade receivables are also examples. It's an example of current assets. Then cash at bank or simply bank, it's an example of current assets. Then cash in hand or simply cash, it's an example of current assets. So basically we are saying current assets are assets which are supposed to be converted into actual cash in a space of 12 months. Then moving on to non-current assets. What are non-current assets? Non-current assets, we are simply talking about assets which stay in the business for more than 12 months. Taking for example, we have land. Land stay in the business for more than 12 months. So it's an asset. It's a non-current asset. Non-current asset. Then buildings, same applies. Furniture, motor vehicles, computers, fixtures and fittings. So all these are examples of non-current assets. Getting back to our question, the question says, which of the following are non-current assets only? A, we have land. Land, yes, it's a non-current asset. Fittings, yes, it's a non-current asset. Then trade receivables, this one, it's a current asset. It's not a non-current asset. So it's wrong. B, land, it's a non-current asset. Office furniture, it's a non-current asset. But cash, it's a current asset. Then C, land, it's an asset. Motor vehicles, again, are assets. Then inventory, it's a current asset. Moving on to D, probably this is the correct answer. We have land, non-current asset. Motor vehicles, non-current assets. Furniture, non-current assets. So the correct answer here is D. Moving on to number 3, it reads, which is the last stage of the accounting cycle? Which is the last stage of the accounting cycle? So before I give the correct answer, let me give you an explanation on the accounting cycle. What is accounting cycle? Accounting cycle refers to the path through which a transaction passed through until it reaches the final destination, which is financial statements. In other words, what we call the accounting cycle refers to a series of steps that a business follow when recording business transactions and preparing financial statements. So the steps followed by business when recording business transactions and preparing financial statements are as follows. The first step is a transaction. So a transaction took place, then as soon as the transaction took place, a paper trail to support that transaction, a paper trail which is the evidence of a transaction, will be created. Then after, the transaction will be identified from the source document, then recorded for the first time in what we call subsidiary books. So from the subsidiary books, we summarize all the transactions that we recorded in the subsidiary books. Then we post the summary to the ledger. After posting the summary to the ledger, we summarize again. Then after summarizing what we recorded in the ledger or what we posted in the ledger, we move on to extract or prepare what we call a trial balance. In the trial balance, that's where we see whether we were recording correctly or there were errors whilst we were recording. So after the trial balance agrees or balances, we proceed to the final step, which we call financial statements. So now the question is, which is the last stage of the accounting cycle? From the answers that we have, A is the correct answer, just because if you can see here, financial statements is the final or the last stage of the accounting cycle. Moving on to number 4, it reads, processing data using electronic method. Processing data using electronic method. A is less costly, B reduce fraud, C requires more labor, D saves time. So we want to see which one is correct between these 4. Number 1, processing data using electronic method is less costly. Is it true or false? It is false. Why am I saying so? Just because when we want to use electronic data processing, there is need for us to buy computers and softwares. As we all know, computers and softwares, they are very expensive to acquire. So A is wrong. Then number 2, B reduces fraud. It reduces fraud. It is wrong. Manual data processing, it is very difficult to trace whether fraud takes place or there is no fraud which takes place. Then moving on to C, processing data using electronic method requires more labor. That's wrong, just because most of the task, most of the work is being done by computers, not human labor. So C is wrong. Moving on to D, processing data using electronic method saves time. This one is very correct. Moving on to number 5, it reads, which document is generated when a business returns goods to a supplier? Which document is generated when a business returns goods to a supplier? So the correct answer is C. Why am I saying it's C? Let me explain each and every document one by one so that you understand why am I saying C is the correct answer. A, it says bank statement. What is a bank statement? A bank statement is a document issued by a bank that summarizes all the transactions in a customer's account. Credit note. What is a credit note? A document used to record the returns inwards. So credit note is not the correct answer. because it's a document used to record returns inwards or sales returns, not returns outwards. Moving on to C, debit note. Debit note is the correct answer. Why? Debit note is a document which is used to record returns outwards or purchases returns. Let's look at D. D is saying statement of account. Statement of account is wrong. Why? Statement of account is a document sent by the seller to the customer that shows a summary of all transactions between the supplier and the customer. Moving on to number 6, a data balance of $500 was written off as a bad debt. Which subsidiary book was used to record the transaction? Let me explain all the subsidiary books and what we record in each and every subsidiary book. Then we come back to the question. The first thing here is to understand what are subsidiary books. So what are subsidiary books? Subsidiary books refers to books of accounts which we use to record transactions for the first time before we post to the ledger. On subsidiary books, we have 7 subsidiary books. The first subsidiary book is called Purchases Journal. The second one is called Sales Journal or Sales Day Book. Then number 3, we have Purchases Returns Journal or Purchases Returns Day Book. Then number 4, we have Sales Returns Journal or Sales Returns Day Book. Then number 5, we have the Cash Book. Then number 6, we have the Petty Cash Book. Then the last one is called the General Journal or Journal Proper. Now let's look at what we record in each and every subsidiary book. What do we record in the Purchases Journal? In the Purchases Journal, we record what we call credit purchases. Credit purchases refers to goods bought for resale by the business on credit, not on cash basis. Not on cash basis. Then in the Sales Journal, we record what we call credit sales. What are credit sales? Credit sales refers to goods sold to customers on credit, not on cash basis. So if the business sold goods to customers on credit, we record in the Sales Journal. Then number 3, we have the Purchases Returns Journal. In the Purchases Returns Journal, we record the purchases returns or the returns outwards. So as a business, if we purchase goods for resale, then we return the goods to the supplier, we record in the Purchases Returns Journal. Then moving on to Sales Returns Journal. In the Sales Returns Journal, we record sales returns or returns inwards. So what are returns inwards or returns or sales returns? Sales returns or returns inwards refers to goods returned by customers to us as a business. So if the customer returns goods to us as a business, we record in the Sales Returns Journal. Then number 5, the Cash Book. Cash Book refers to book or book of original entry, which we use to record all cash transactions. What do we mean by cash transactions? The movement of cash into the business and out of the business. So whenever there is cash inflow and cash outflow, we record in the Cash Book. Then number 6, the Petty Cash Book. What is the Petty Cash Book? Petty Cash Book refers to a book of original entry, which we use to record all cash transactions with small amounts. Meaning to say, all cash transactions which involve small amounts are recorded in the Petty Cash Book, not in the Cash Book. Moving on to the last one, General Journal. What do we record in the General Journal? In the General Journal, we record all the transactions that cannot be recorded in either of the books of original entry we talked about. Meaning to say, transactions that cannot be recorded in the Purchases Journal, sales journal, purchases returns journal, sales returns journal, cash book, pet cash book. All the transactions that cannot be recorded in these subsidiary books are then recorded in the general journal. There is no specific group of transactions which we record in the general journal. So in simpler terms, we say all the transactions which cannot be recorded in these 6 are recorded in the general journal. Coming back to our question, the question says a debtor balance of $500 was written off as a bad debt. Which subsidiary book was used to record the transaction? The correct answer is A, just because debtors are not recorded, bad debts are not recorded in the purchases journal, are not recorded in the sales journal, are not recorded in the sales returns journal, definitely are recorded in the general journal. Moving on to number 7, damaged goods sent back to the supplier are recorded in the, as we explained earlier, goods returned to a supplier are called purchases returns or returns outwards. And we said purchases returns or returns outwards are recorded in the purchases returns journal. So the correct answer is B. Moving on to number 8, the total discounts on the credit side of the cash book is. So the correct answer is C. Total discounts on the credit side are debited to the discount allowed account. Moving on to number 9, an allowance for prompt payment received from a supplier is recorded in the question is simply talking about discount received. Discount received. So discount received, as we all know, is recorded in the cash book. It is not recorded in the pet cash book. It is not recorded in the purchases returns journal, in the sales returns journal. So the correct answer is A. Moving on to number 10, a summarized history of transactions in relation to a particular person or item is. A financial statement. A is wrong, just because financial statements either they show the profitability of the business or the financial position of the business. So A is wrong. Then B, trial balance. Trial balance is wrong, just because trial balance is just a list of debit and credit balances extracted from ledger accounts. Then C is the correct answer. So an account is the correct answer. That's because an account is a formal record which shows the history of a particular person or an item when you are in accounting. Then D is wrong, opening statement. That's all for today, guys. See you in the next lesson.